What if, just hear me out, what if I told you that your house just might be able to help you pay off your mortgage years earlier and potentially help you buy another investment property? What? All right, so normally you may not be hearing this from other mortgage professionals because after all they're in the business of selling a mortgage and keeping people in a mortgage and not necessarily paying it off, right? So and this concept may sound a little too good to be true, right? And generally speaking, if something does sound too good to be true, say it out loud, it usually what? Yeah, it usually is. So let's just put down the internet pitchforks. This is not a new concept. This is not a gimmick. It's actually being used by many people that are very wealthy, and it's not really advertised because after all, it is about paying off a mortgage, and that is the dream, right? Of actually owning your house outright. Um, so let's get into it. The actual strategy is called velocity banking. Okay? And before you get excited and start yelling, show me where to sign, show me where to sign, or the other side, you know, there's something that you need to understand. Velocity banking is not free money. I know a lot of people are out there pitching free money and easy this and easy that. It's not, okay? It's an advanced financial strategy that uses your cash flow, and in some versions, a HELOC to accelerate your mortgage principal reduction. You can also use credit cards in some cases, depending on the credit card. But whether it actually works for you depends entirely upon your numbers, and you need to get to a certain level of cash flow before you can actually even start using this strategy. So, here's a simple version of what velocity banking is. Normally, you make your mortgage payment every month, right? And part of that payment goes towards interest, another part goes towards principal. And I'm sure you've all heard, well, if you make an extra payment at the end of the year, or if you pay a little extra bi-weekly, or some of these other strategies, well, you'll take a payment off every year. Well, okay, yeah, that's cute. We're not talking about that. We're talking about something a lot stronger. Velocity banking attempts to accelerate the amount of principal that you're paying down. One common version uses the home equity line of credit, or HELOC. You borrow a larger chunk of money from your HELOC, and then you use that money to reduce the balance on your primary mortgage, and you use arbitrage the money. Okay? And you're basically leveraging the difference between that loan vehicle against the mortgage loan vehicle. And then you just repeat the process. As they say, wash, rinse, repeat. You can do this per quarter, every 3 months or so. You save up some money, yada, yada, yada. Okay? The objective is to reduce your mortgage balance faster, which can potentially reduce the amount of interest that you pay over time. And we're not just moving debt around, okay? I know some of you might be asking about that, and that's a great question. Are we just moving money around? Well, kinda, and that's why you need to understand what you're doing, okay? You're not magically creating money. You're not making debt disappear. You're potentially moving debt between the different loan vehicles or debt vehicles, different accounts, while strategically directing your cash flow towards principal reduction. And then here's the big question. Does the math actually work? Because a HELOC has an interest rate as well, and that rate may be variable. So there can also be fees, minimum payments, and other costs. So if you're paying a higher rate on the HELOC than you're saving on your mortgage, congratulations. You've invented a very complicated way to pay more interest. And that's why this strategy requires actual numbers, not TikTok math and not any of the other gurus out there that are on Instagram and on the other social channels selling you their products or selling you their trainings on this, okay? So where does the velocity come from? The wealthy actually use cash flow and debt as vehicles. They use debt to generate wealth, and they use cash as velocity to pay down that debt. So the idea is to create more velocity in how quickly your money reduces debt. And instead of simply making the minimum scheduled mortgage payment, you're aggressively attacking that principle. For example, imagine you have, let's say a $400,000 mortgage, okay? And you have a meaningful monthly cash flow after paying your normal expenses. So instead of letting that extra money sit idle, a properly structured strategy may allow you to use that cash flow to aggressively reduce debt. And the faster you reduce the principal, the less interest you pay over the life of your mortgage, and potentially the faster you build equity and your generational wealth. And I said something very critical earlier in that passage, right? Cash flow. You need to already have some cash flow happening. If you're living paycheck to paycheck and you have zero cash flow and you got more going out than coming in, then this strategy won't work for you yet. All right, so start building up your cash flow. Start paying down the debts to have some cash flow. And now we get to the interesting part, your equity. So let's say you bought a home and over time you're paying down your mortgage. Maybe the home appreciates and now you have a larger amount of equity. Generally, you want to have at least 20% of equity, pay down the PMI, and have enough to be able to qualify to get a HELOC from your lender, And that equity is an asset. You're no longer simply renting a place to live, as I mentioned in another video where someone said a mortgage is just renting a house. You actually own the house a little bit more with each monthly mortgage payment that you make, And eventually, as that equity grows, that equity can give you an additional financial options, a lot more financial options. So you could use that equity to buy another property, invest in a business. I would not recommend using your equity like most people do. Oh, well, we're going to go on a vacation and we're taking a loan out from our equity to go on this fancy vacation. No, you don't use debt to buy other debts. You use debt for cash flowing assets and to generate more wealth. Okay? So, can you use it to buy another property? Well, potentially, yes. And there's where real estate investing gets interesting. And I actually knew a gentleman who did this to create his real estate portfolio of rental properties. He did it with one house, and then as he got the second investment property, the rent was covering it, the second house. And then as that built equity, he started using the process on that second property. And it snowballed. Okay? So let me get back to the basics here of where we're at. So let's say you've built substantial equity in your primary residence. Depending on your financial situation, available lending programs, credit, your income to debt ratio, and the property's value, you may be able to access some of that equity and apply for a HELOC and be approved for a HELOC, a cash out refi, or potentially by selling the property and get that equity that way. And then that capital can potentially be used towards another investment. So let's say you wanted to buy another property, an investment property. So investment property number 2, instead of owning one property, you potentially own 2. And then the second property can generate rental income and potentially appreciate over time. Now, without getting too deep into the weeds, rental income, you really want to have rental For the math to work, you really need to be making, really $400 in profit from the rental on top of, paying the mortgage from the rents and all that. I shoot for at least $400 profit, you know, and then that rental property potentially is building more equity, and eventually you can have another asset that gives you additional options. And then you can move on to rental property 3. And then you're just repeating this process through the line. And that's what this gentleman that I knew, that's what he did. And he ended up owning 60 rental properties. And now that is his retirement plan. He's not relying on Social Security. He's not relying on what's going on in the stock market. He knows that people need a roof over their head, and he has rental properties that are paying him over and over and over again. But, let's pump the brakes, okay? We can get really excited when we start thinking about this stuff. So let's stop right here, because this is where YouTube gets very dangerous, okay? You're going to hear someone say, use your HELOC to pay off your mortgage in 5 years. Now, while that is very possible with this plan, the math has to work out, okay? You got the video saying, oh, pay off your house in 5 years, and we got this plan, and we got that loan, and blah, 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 blah. And then there's the dramatic music, the Lambo, and somebody standing in front of a mansion. Please, run your numbers. Velocity banking is not guaranteed to pay off your mortgage faster. It doesn't eliminate interest. It does not create equity out of thin air. Using a HELOC to invest in another property introduces additional leverage and additional risk. All right? If the property, if its value falls, if your income changes, if the HELOC rate changes or increases, if the investment property has vacancies that you didn't plan on, any unexpected expenses show up, you still owe the money. So your house doesn't get a memo saying, don't worry about it. Richard said that this will work. Now, granted, do the math, run the numbers with your specific situation, and make sure the numbers work. This video is not about selling velocity banking. I'm not making any money off of this. I'm not promoting this. I'm just sharing some information of what is possible. And it is an advanced strategy. Okay? So, who might this make sense for? If you have strong, consistent cash flow, if you have significant financial discipline, if you have emergency reserves, a solid understanding of your debt and how to use your debt, how to leverage your debt. The wealthy, so Dave Ramsey drives me nuts. And let me step back. Dave Ramsey is great if you're a financial train wreck and you have zero discipline with your finances and your debts. Yeah, follow Dave Ramsey. But I guarantee you, wealthy people know how to use debt. They know how to leverage debt to build wealth. Okay? And so they are very disciplined with it. Were they disciplined on day one? Maybe, maybe not. But it does require discipline. Okay, so a mortgage and a HELOC structure where the numbers actually make sense. Understand that. It has to make sense. And then you need to know a clearly defined investment strategy. This isn't something I'd recommend simply because somebody on Facebook or Instagram or YouTube said, banks don't want you to know this one trick. Have you heard that one? Yeah, I know I have. Banks don't need another conspiracy theory. They got enough paperwork. So here's the one thing I want you to remember from this video. Velocity banking is a great advanced strategy, but it's not about creating money, and It's about potentially creating more efficiency in how you deploy the money that you already have. Use your cash flow strategically. There is a game by Robert Kiyosaki. That's the one thing that I do recommend from him. Play the game cash flow and start thinking creatively about how do you generate more cash flow to potentially accelerate principal reduction, build equity faster, and potentially use that equity later to pursue additional investments. Buy a boring business. Buy something that you are knowledgeable in, not just because you saw it on YouTube, but find something that you're knowledgeable in to put your money into. But every step has to make financial sense. All right, so if you're a homeowner thinking I'd love to pay off my mortgage faster, or you'd love to get a mortgage to begin with and get out of this rental situation, or you're thinking, I'd like to eventually use real estate to build a portfolio, don't start with this strategy. Start with the math. Look at your mortgage, look at your interest rate, look at the cash flow, look at your equity, look at the HELOC terms, look at potential investments, and then determine whether the strategy actually improves your financial position. Because the desired outcome isn't to have the coolest financial strategy. The desired outcome is to have a strategy that actually makes more money, reduces your risk, and gets you into reaches your financial goals faster. And one guy that I follow is Garrett Gunderson. He's the guy that really makes a lot of sense to me. Once you're at a level of financial discipline and you're ready to take that next step to grow your assets, I follow him. And then a CPA, which is very important to understand taxes, Mark Kohler, I follow him. I'm making no money off of recommending these guys. It's just a guy in front of my laptop sharing some information that I happen to know. Take it or leave it, and do with it what you will. And that's it. All right, so I'm Richard Sailing, a licensed loan officer. And if you found this helpful, smash that like button down below. Share the video, like it, subscribe, and share it with someone who may be looking to buy a house and need some information on getting into a house. All right? And remember, don't fall in love with the strategy. Fall in love with the numbers.